Hello everyone, today we'll be talking about adjusting entries. In accounting, there are two ways of recording revenues and expenses, cash basis and accrual basis. The cash basis of accounting records revenues when cash is received and expenses when cash is paid. In the accrual basis of accounting, revenues are recorded when they are earned and expenses are recorded when they are incurred. Therefore, to ensure that all revenues and expenses are recorded accurately under the accrual basis, accounting information systems use something called adjusting entries. So what are adjusting entries? Adjusting entries are entries that are conducted in the general journal at the end of the accounting period that ensures all accounts are recorded under the accrual basis. This means that revenues are adjusted to the period in which they are earned and expenses are adjusted to the period where they have been incurred. So, when are adjusting entries necessary? Adjusting entries are necessary when we have deferred revenue, deferred expense, accrued revenue, and accrued expense. A deferred revenue is when companies receive the cash before they have provided the service. A good way to think of this is airlines receiving your money before you go on your flight. Accrued revenue is when the service has been provided and the revenue is earned before the cash is received, and this is also known as a receivable. Service revenues are accrued revenues as the service has been provided and the revenue has been earned, but the cash is received after the service has been provided. Deferred expense is when the cash is paid before the expense has been incurred. An example of this is rent. Rent is paid periodically in advance so you can occupy the space. In the last one is accrued expense. Accrued expense is when the expense has been incurred and it will be paid later. An example of this is paying workers at the end of the week.